Welcome, everybody, to the original Biodiversity Finance. I'm Susan de Witt, and in terms of my title, that does not mean I'm a particularly confident PhD student. I'm actually a veterinarian, but I've been working in innovative finance for the last 10 years. That basically means getting more capital into social, environmentally aligned businesses. In fact, the last role that I was in, I was working with about 60 fund managers across the continent, and they were targeting a capital raise of about 1.5 billion. And one of the very noticeable things or disconnects between them and the investors that they were interested in other words, the DFIs, was the real kind of lack of knowledge and exposure to the kind of innovation that they were needing to undertake at a ground level to be able to make fund economics work on the continent. With the adoption of the Global Biodiversity Framework, UN Decade on Ecosystem Restoration, obviously governments, multilaterals have gotten together and set very ambitious targets for conservation and restoration, and suitable targets in the face of the biodiversity crisis and breakdown in ecosystem services. Yet the practical challenge remains: how do we finance this at scale? And in Southern and East Africa, we have a market-based, and I think as yet relatively unrecognized or globally unrecognized model of how this could be done. And it's not funded through nature-based carbon credits, nor is it funded through biodiversity offsets, but rather it's a relatively vanilla business model, agricultural business model that is privately funded, maybe grant funded through donors, but through shareholders, through repayable finance, and to the point when these businesses can become sustainable. It's with this in mind that we undertook a rapid evidence review. Our research question was really looking into or exploring the financial performance of wildlife-based land use in these regions. And I say we because I have been collaborating with Hayley Clements, who's situated at the University of Stellenbosch, and she's my supervisor, but alongside Sophos and Prof. E.J. Milner-Gulland at Oxford, with input from Brian Child and Richard Field as well. We were looking at non-state intervention across non-consumptive activities in semi-arid regions, semi-extensive farming. So we weren't looking at crocodile farming, ostrich farming, or even intensive buffalo farming. Really, we were looking at more extensive than that. And we limited it to primary research, so empirical studies where they'd actually collected data. We started out with over 4,000 papers, ended up with 75. 48 of those are peer-reviewed. 41 contain financial metrics and ratios. So a lot of the graphs that you're going to see later in the study are built off the back of those 41 papers, but the rest of them round out our knowledge in terms of profit drivers and risks and so on. What we didn't include was a large body of literature around community benefit distribution. A lot of those studies calculate that the absence of understanding what the investment in the land is, or what the expenses are of those communities, or what part of the value of the land is actually distributed to the community versus what goes to government or operators. We also excluded studies that look at basically national revenue studies around particular activities. We were wanting to understand at a land unit level, what is the financial performance? Okay, so this gives you an idea of the cumulative studies across time from 1975. You can see there is a real dominance of Southern Africa, underrepresentation of East Africa, and within Southern Africa, South Africa. Temporally, first study 1975, but it really is only in the 90s that you start to see this increase. And maybe I just want to point out Zimbabwe. A lot of the pioneering research was happening in Zimbabwe prior to the fast-track land reform in 2000. Some people know a lot about this business model, and some people know very, very little. So I'm going to take you through the talk, guided by this framework. And what this tells us is that country regulation and resources, like land tenure, wildlife rights, really determine what institutional types prevail, be that private, communal, operator. And those institutional types influence the kind of business activities that happen on that land, be they consumptive, non-consumptive. And those activities lend themselves to different management strategies. So whether you are managing for density, diversity, species composition, etc. Ultimately, those factors combine to give you a set of financial and ecological outcomes. And those outcomes then influence policymakers and the markets as to where they allocate resources going forward. So what does that look like in action? Again, this is going to guide our talk. In red, we have private wildlife ranches and reserves. These are freehold properties, devolution of wildlife user rights, individual or corporate decision-making, a huge range of activities, and really managing for profit versus conservation. Community conservancies in green, that's a second archetype. These are customary tenure. Again, user rights have been devolved, collective decision-making, generally confined to trophy hunting and ecotourism. And really what communities are doing are balancing socio-economic benefit versus natural resource management on the land. And then finally, you've got operators in blue that are working in game management areas. The studies in this body of literature pertain to operators working on state land. So operators can work on community or private land, but for the purpose of what we're talking about today, the archetype refers to operators who really are bound by the rules on state concessions, the quota system, and they are often, their behaviors influenced by the length of the lease under which they're operating. We'll start out with section 8. I'm going to take you through each of the sections. Just to orientate those people who maybe aren't so familiar with the tenure system in Southern and East Africa, just remember red, private, green, communal, blue, state. You can see that there's a skew towards private tenure in South Africa and Namibia. Zimbabwe looks slightly different now, but when these studies were done, that is what the tenure system looked like. So that's what Zim looks like now. Then when it comes to wildlife user rights, all of these countries devolve wildlife user rights, but across a spectrum of certainty. So on the one side, you have South Africa, where you have ownership rights on properties that are fenced. On the other side, or in Kenya, you have user rights over non-consumptive use. And in between, you have a range. I'm going to show you what the revenue per hectare is, the aggregate revenue per hectare across each of these institutional types according to country, and point out specific values. Bold figure at the top, that's average revenue per hectare. The number underneath is the number of sites on which that average is based. So you can see in South Africa, it's on average $50 per hectare. And I wanted to contrast that with Namibia, which is about 16. And that's because at face value, South Africa and Namibia could probably look quite similar. But actually, there are nuances with regards to, say, the devolution of rights, ownership versus user rights. There are other factors in Namibia. For example, it's more arid. The farms tend to be bigger. So on average, they're about between 10 and 15,000 hectares, whereas in South Africa, the farms are on average about 5,000 hectares. The other potential contributor is that in Namibia, there is a ban on buffalo hunting outside of the Zambezi region. And buffalo hunting is quite a significant contributor towards trophy revenue. I perhaps also want to point out that the revenue that is recorded here consists of tourism and hunting revenues and is quite often broken down in studies, bed nights, price of trophy per animal, the price of meat at auction, depending on the animal. So there's a lot of detail. Now, I want to contrast that because your immediate reaction might be, wow, in the community systems, that's a lot lower, excluding South Africa on the left, and I'll give you the reason why there. But on average, the revenue per hectare is a lot lower. But that revenue is reflective of the revenue that the community or the landholder receives. There's a lot of value that's extracted by the operator and by government on this land. And we have very little information, really, of what that split is. There's a few studies. So Barnes has done some work around that, John Barnes, where 4% of lodge operator revenues go towards 10% of hunting revenues. In Namibia, it's higher. Calvalage has done a study where he has calculated that's about 20%. And a lot of that has to do with the fact that in Namibia, those user rights are devolved to community level. Government is less extractive than in Botswana or Zambia, for instance. Operator, again, are we comparing apples with apples here? So with that operator data, some of the studies report the income that's coming directly to operator wholesale. Some of the studies report the income that's going to government, and they give us an indication of what the premium is. In other words, what we can tell from the data is that generally about 20 to 30% of the income goes to government. But again, you can see that there's a distinction between Zimbabwe and Mozambique, and Mozambique is sitting on the maybe less secure side of the regulatory framework. It's probably a good time to say that most of these studies, in fact, there are only 3 studies in this group that compare countries within studies. I mean, what we've done is aggregated across national studies to give you these figures. But this is a great quote from Alex Chideko, which is a study which compares South Africa with Namibia, and I'm going to read this out. In South Africa, where landowners retain full returns from the marketing of natural resources, the wildlife economy on private land has outgrown the economy of the national park after decades of commercial investment. In Zambia, centralized ownership of natural resources and high taxation of resource use counteracts market forces to effectively constrain the growth of the wildlife economy outside of the national park. So I'm going to move on to section B, where we are going to be specifically looking at the institutional types. We're going to compare revenue, expense, profit, capex. And here's a caveat here. These figures are based on subsets of those data. In other words, not all studies collected every ratio. And so they don't neatly fit into each other. Revenue minus expense equal profit. So don't read it that way. But this is basically what we have in that limited sample. I'm going to start out looking actually at capex. So start on the other side. Again, going to explain the difference in what we are seeing here. So when it comes to private land at $500 per hectare on average, that includes the cost of the land and game acquisition. About 20% of that, at a minimum, goes towards infrastructure. So 20% of that, say $100. That $100 is probably more comparable with your community or operator models, but even so, not directly comparable. Because when it comes to community, the reporting of community capital expenditure, so maybe just to take a step back for those who don't know what capex is, that is the money that goes in to establish an enterprise and get it up and running. And so for communities, that is going to be limited generally to kind of staffing infrastructure and maybe some bomas or places where animals can be managed more intensively. When it comes to operators, quite often those expenses are temporary. So they're building camps, they might be building airstrips, roads, etc., to get into an area. But there's a huge discrepancy there, right? This is something which you saw in the previous slide, the difference in revenue per hectare. I'm not going to go through that again. What I'm going to focus on again is expenses. And these are operational expenses, not capex. So these are ongoing expenses every year. And on private land, you're looking at an average of $40 per hectare, and a very low expenditure when it comes to community and operator expenses. That private land value is probably reflective of the level of intensity of the land, and also reflective of the amount of value that's coming into the landholder that can then be used for conservation purposes on the land, be it anti-poaching, be it habitat management, etc. For completeness' sake, I'm going to add profit in there, but I'm going to dig a little bit more into that in the next section. And as you can see, capex. Again, that's a quote from Brian Child. Community-based natural resource management has attempted to replicate the economic success of wildlife on private land in complex institutional circumstances of Africa's communal areas. Our suggestion is that the opportunity cost of weak institutions are enormous, and the return on investment from developing new institutions high. That applies to putting resources into these areas as well. There are 4 quick observations I want to make from this, mainly expense data. So whilst profits are not high compared to capital outlay, I mean, you're going to look at that ratio and it's not going to look particularly attractive. There is evidence to suggest that the appreciation of land has a significant effect on that return over time. And that's not unusual when it comes to natural asset investment. I mean, Kluti's done quite a few studies, Flippy Kluti, looking at the practical effect of that ratio on conversion of land over time. It takes time. It takes time to get to a point of financial sustainability, 10, 15, even 20 years. The second point is that even though there are opportunity costs associated with wildlife-based land use in communal conservancies, cost that has already been sunk, there's no need to pay for the land, and quite often game is donated or fences are dropped between national parks. So your startup costs are a lot less, which presents a really enormous opportunity there. Thirdly, I've already said the 4th point earlier, and that's about the capture of value at a land level actually drive conservation outcomes at a land level. So the more you extract centrally, the less conservation you're going to get. Fourthly, by comparison, there's a study that was done by de Groot quite a few years ago, 2013, but he looked at the cost of ecosystem restoration across multiple different biomes. And one of the biomes he looked at was grassland restoration. And he estimated that it costs between $200 and $1,100 per hectare to restore grasslands. That was in 2013. That is up to $1,400 per hectare today. This looks like a bargain compared to that. So we're going to take a bit of time looking at business activity. Maybe the first and most important contrast we're going to make is between the profitability of alternative land uses. All of the studies mention conversion from livestock to wildlife. 28 studies specifically study that conversion. Their thesis is around the conversion, and about 17 or so of those studies provide quantitative data around what that means. So that's what these figures are taken from. Again, I'm going to be looking at those crosses, which are the averages. You'll recognize that revenue per hectare on private land on the left. And on average, the productivity is about 3 times that of livestock. When you get down to profit and ROI, it's a negligible difference. At scale, it's a big difference, but really you're looking at a difference between 5 and 6% according to the data. I do want to point out, though, that ROI isn't always very clear about the risk associated with land use. So when it comes to livestock, we know that productivity is directly related to stocking density. The more cattle you have, the more money you make. And what that ends up doing is causing overstocking and degrading land. With wildlife-based land use, the profit per head of game is higher, so you can stock less. And so your chance of land degradation is lower. One study also points out that the productivity of cattle on degraded land is less than that of wildlife on degraded land. So say you're starting out with degraded land, like for like, you're getting better productivity from wildlife. So there's a risk associated with livestock in semi-arid regions that isn't necessarily built into these models. When it comes to the risk associated with wildlife-based land use, I mean, you can see that there's tremendous volatility. Like there's a tremendous difference between high and low here. And investors don't really like that. They like to be more certain. There's one demand side risk that I just want to point out that is felt at a landholder level. You know, that would potentially translate at an investor level. But that is that of the ban of consumptive use, and maybe more specifically, the ban of the international import of trophies. 11 studies mention that specifically, and some of them actually calculate what the land conversion repercussions would be of that being extracted. I think there's a couple of things to point out there. One is that it's particularly risky on land that cannot or offer tourism services, so land that's less attractive. But secondly, Hunting revenue provides bridging finance for livestock farmers to convert to wildlife-based land use. There's a really interesting graph in Vincent Vattel's recent thesis, which shows at a macro level how the market has developed in Namibia. Prior to 2000, cattle dominate. From 2000, for 10 years, you get a threefold increase in hunting. And from 2010 for 10 years, you get a fivefold increase in tourism. And that really indicates that there is a progression from consumptive use to non-consumptive use if really those revenue streams are allowed to flow. The next slide gives an idea where each of the wildlife activities sit on that spectrum. So unsurprisingly, phototourism sits at the top. You've got breeding of high-value species underneath that, although pretty volatile in South Africa. There was a crash in 2018. Underneath that, wildlife livestock mix. The interesting thing about that, a couple of studies coming out post-COVID, and certainly in relation to climate change, is that that business model tends to be more resilient. And then you've got your consumptive use at the bottom. And really that's partly due to the fact that there's a limitation around the number of animals that you can harvest from a piece of land. What's missing there is game meat or venison. And there is quite a policy push around expanding wildlife-based land use to include that. Again, requires a lot of investment into value chain, not just reliant on the landholder themselves. Getting back to the 6% ROI figure, the other thing ROI doesn't do is determine your return over time. So that's what IRR does. Limited number of studies looking at your performance over about 10 years or so. It's really variable. Ranges between -13 and 45. I can't really make an average, but the median was 16. So I'm just going to throw that out there because there's a couple of data points that I want to share with you that situate this in the market. Not a lot of IRR data on particular sectors, particularly in Africa. So I'm reaching for these. But Hamrick did a study in 2016. Conservation investors, their projected return from sustainable food and finance between 5 and 10%. Their projected return from habitat conservation under 5%. So we're in line there. Delberg did a study on smallholder farmers in Africa looking at 3,500 loans. Average kind of institutional return, -5%. And if you're looking at African PE funds where they're targeting between 20 and 30%, not a lot of data on returns. South Africa produces some of that data. Your IRR over 10 years, naught, less than that. So it's looking like a good investment opportunity. I'm going on a little bit long, but we're getting to a slide which a lot of people in this room are going to be most interested in. And that is looking at, we were trying to see if there was a relationship between financial and ecological outcomes. And that's not just, the size or carrying capacity or rainfall. We understand that there's going to be some correlation there. But we were looking at what management decisions the landholder can take that might influence their profits in the long term. And we're looking at synergies and trade-offs. Synergies being the better your ecological outcomes, the higher your profits. Trade-offs being the higher your profits, well, your ecological outcomes have to suffer. So what we found, about 65% of the studies actually collect data on ecological outcomes. Most of that's, 40% of that is actually primary data. And more than half of those studies actually have a control within their study design. We identified 5 ecological outcomes where this relationship exists and did a very rough kind of evidence strength score around the relationship between these outcomes and financial return. These are the results. The green bar shows a positive outcome and the orange bar shows a trade-off. What you can see there is that density has the strongest relationship when it comes to financial performance. And on the positive side, the more abundant your wildlife is, the more returns you make. And there's certain business models where there is a minimum abundance against which you can undertake that particular business model. On the left-hand side, what you will find is that overstocking and overharvesting increases profits in the short term, but decreases them in the long term. When it comes to species composition, big five increases your revenues. Buffalo, high-value species, sable, increases your revenues from breeding and live sales. On the left-hand side, what you found, particularly in South Africa, is that once the kind of plains game market was saturated, you were getting color mutants or genetic variations that obviously are not kind of ecologically desirable, that were increasing profits in the short term. Predators are quite an interesting case. They actually sit on both sides of that spectrum. You have predators and you have ecotourism on your land. It increases your revenue. But if you're running a hunting or a live sales business, then predators are going to eat your prey. So there is depredation that's associated with that. But quite a few nuanced studies that report on the nuance, particularly of lions in the landscape. And then I'm not going to go into detail, but diversity, habitat management really correlates. The more diversity, the better your habitat, the more profit you're going to make. So what's good for profit is good for nature. I left out the most important ecological outcome in that previous slide, and that is habitat conversion. Most of the private and communal land in the studies that I've shared with you, the land has converted from livestock to wildlife. The SADC working group has done a rough estimate of the area in the region that has been converted, 35 million hectares on private land, 100 million hectares community land. And from a state perspective, in those game management areas, they are at risk of converting from wildlife to livestock if they are not financially self-sustaining. When a habitat is converted to wildlife, not perfect, but there is a tendency towards ecological integrity, native species, diversity. There's a tendency towards better ecological or ecosystem functioning, carbon sequestration, livelihoods. There are quite obvious benefits to local beneficiaries and maybe not so obvious benefits to global beneficiaries who benefit from this massive ecosystems restoration that's happening on the other side of the world. So I lured you in here to talk about the fact that despite this recent kind of hype around biodiversity finance, this has been happening in Africa for the last 50 years. This is the original biodiversity finance. So what have we learned today about it? I think we've learned that wildlife-based land use is a bankable proposition. Revenue per hectare, expense, ROI. We've learned that when ecological outcomes improve, profits increase. We've learned that there is a massive regional ecosystem restoration story in Eastern Southern Africa that has been privately financed. When we don't have very many details about that, what that is. And in fact, that's what my empirical research will be on going forward. And so this holds lessons for rewilding in the region, other parts of the world. And there's a call to action for international stakeholders, particularly international investors. If they are serious about market-based models when it comes to ecosystem restoration, this is an investment opportunity. What we really kind of want to know is, where this next tranche of funding is going to be coming from for the next wave of conversion, much of which will include community, land, and emerging farmers. That's it. Thank you.